By now, everybody knows that the stock market took a big hit on Friday. That was August 26th. The Dow was down over 1,000 points, and equity losses have continued on Monday and Tuesday. And so the question is, why is the stock market so violently going down? The headline on page A1 of the Wall Street Journal's weekend edition said, Fed chief's hardline sinks stocks. That seems to say it all. It looks like that after Powell's 8-minute speech, stock traders have finally decided what the bond traders have known for some time. That is, that the Fed is hell-bent on bringing down year-over-year inflation and now appears willing to tolerate a recession of some significance. Result is that the equity markets are not playing catch up, they're playing catch down. Here are some key remarks from Powell's presentation. Quote, while higher interest rates, slower growth, and a softer labor market will bring down inflation, they will also bring some pain to households and businesses. Our responsibility to deliver price stability is unconditional. We will keep at it until we are confident the job is done. Those statements say that the Fed recognizes a recession is coming, but is tightening policy anyway. And this quote is key. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. So a Fed pivot, that is moving policy toward less restriction or even toward ease, that pivot won't happen anytime soon. But the remark about prematurely loosening on Powell's part is really disingenuous. He was clearly referring to the Arthur Burns era of the 1970s, when the Fed kept monetary policy too easy, even while inflation expectations were high and rising. That remark, however, is short-sighted and really represents the exception, not the rule. The history of the post-Volcker Fed is that because they do not know how long the lags are between when they implement policy and the impact on the economy, they're always late in loosening policy, long after the recession is well established and ingrained. Most monetary economists know that the Fed is often the responsible party when it comes to recession's blame. In today's case, the recession is already staring them in the face as they resolve to raise rates higher and for longer. And that's because they have tied their wagon to lagging, backward-looking indicators like the CPI and the Personal Consumption Expenditure Price Index. Perhaps this may be due to the political atmosphere, where the current administration is being blamed for the highest inflation in more than 40 years. So they must be getting a lot of political pressure. The equity market's nasty reaction appears to have hinged on the realization that there isn't even a glimmer of hope for a Fed pivot to easier policy or the much wished for soft landing. The bond market reached that conclusion several weeks ago, and now we have an inverted yield curve where short rates are higher than long-term rates. As a result, it appears that the equity market rally of the past few weeks was just the typical rally that occurs in all bear markets, called a bear market rally. And that means that the June lows are likely to be retested as the incoming economic data continues to be dramatic to the downside. Many indicators now showing up at levels worse than what occurred during the Great Recession. In the second quarter, despite what Wall Street says, there were a lot of poor earnings reports, especially lowered guidance. Those negatives were in the background, just waiting for a catalyst. And what we got on Friday when the Fed took such a hard line, Walmart, Target, and Kohl's disappointed early in the reporting season. But it didn't end with those companies. Recently, Nordstrom's, a retailer catering to the affluent, cut their profit and sales forecast and remarked that demand and traffic are slowing markedly. Macy's reduced their earnings guidance by 30%, while Ross and BJ's Wholesale announced inventory clearance sales. NVIDIA in the semiconductor space warned on revenue, too much inventory there too. Peloton had another quarterly loss, and Dell Computers cut its outlook, citing slow personal computer sales. To show the extent of the inventory issue in retailing, on a year-over-year basis, Walmart's inventory are 25% higher, Target's are 36% higher, and Kohl's 48% higher. And these inventory issues aren't just in the retail sector. They're spilling over to other sectors like housing. Housing is one of the major components of GDP, so issues there are sure to affect the economy. The fact is, housing is sinking and sinking fast. We now see excess inventories in the new home space, and that's due to the rapid slowdown in the sales of those new homes. There are fewer prospective buyers, and cancellations are the highest since the COVID lockdowns. The number of months of inventory has skyrocketed. It will now take 11 months to sell the existing inventory at today's sales pace. Just a few months ago, when the market was hot, that number was 3 months. And just for clarity, normal is 6 months. So we've gone from a hot market of 3 months of inventory to a very frigid one of 11 months of inventory, and we've gone there pretty rapidly. New home sales fell 12.7% in July, and in June, they fell 7.1%. So over a 2-month period, that's just a hair's breadth short of negative 20%. On a year-over-year basis, new home sales are down 30%, and they're now falling at a 60% annual rate. July's level of sales is actually less than the COVID low of April 2020. Toll Brothers, America's largest luxury home builder, says its order books contracted 60% in July. That's a huge number. Furthermore, existing home sales, these are sales of existing homes, they went down almost 6% in July. They are down 6 months in a row and are off 20% on a year-over-year basis. Again, another huge number. Marketing times, they're now rising and prices have begun to soften. Black Knight, a reporting agency, said that prices of existing homes actually fell marginally in July. It's the first decline in 7 years. Pending home sales, these are new contracts just signed. They fell 1% in July on top of a 9% fall in June. That means pending sales are nearly 10% lower than they were last May, just 2 months earlier. Such sales have been down in 8 of the last 9 months. And on a year-over-year basis, those pending sales are down nearly 20%. Again, that's quite a significant fall. And the worst still appears to be ahead as mortgage applications for purchase continue to fall each week. They are down 21% on a year-over-year basis, and except for the COVID lockdown period, now sit at a 22-year low. Now let's talk about refi applications. These are applications to refinance an existing home. This has been a source of liquidity for many American families. And until recently, they were using the money they borrowed to buy big ticket items like cars, or to remodel their kitchen, or to install a swimming pool, or maybe even to go on an expensive vacation. But with rising interest rates, that's all gone away. Refi applications are down an amazing 83% on a year-over-year basis. That's a huge number. Besides retail and housing, we're also seeing issues in manufacturing. The S&P Global Purchasing Managers Index for the US for August showed up at 45. 50 is the demarcation line between expansion and contraction. July was also in contraction at 47.7. When we look at the regional Fed manufacturing index, we find that Richmond's index was -8. 0 is the line between expansion and contraction, and it was 0 in July. So -8 in August is contraction. In their sub-indexes, shipments, orders, backlogs, and capacity utilization were all in contraction. And vendor lead times, this is a measure of supply chain tightness, was -14, the lowest since March of 2009. This particular metric was 0 in July and as high as 45 last March, and shows what is happening on the supply side. And by the way, this is a positive sign for lower inflation in the future. Let's look at the Kansas City Fed Manufacturing Index. At 3 in August, it was down from 13 in July, and it was 37 last March. The fall over the past 5 months is the fastest in the index's history, even faster than during the Great Recession. Like in Richmond, production, shipments, and orders were all in negative territory. If we look at the Chicago Fed's National Activity Index, which has over 80 variables in it, it showed up negative for the second month in a row, and all of its sub-indexes were contracting. The New York Fed's Manufacturing Index, -31 in August. So it appears that manufacturing, like retailing and housing, has also hit a wall. The only good news here is that with the pullback in demand that we've already seen, supply is now more than adequate, and we should see much lower levels of inflation going forward. To compound the economic issues, the rest of the world isn't doing very well either. Just briefly, the Eurozone continues to fall into an energy-induced recession, with Russia now closing the natural gas pipeline for 3 more days for so-called maintenance. In China, the central bank has eased monetary policy, unlike our Fed. They recognize that they have a recession on their hands. China's economy continues to be plagued by its real estate issues, by lockdowns for COVID, and now they have a drought, which will impact their food supply this winter. By the way, there's no longer any mention of its 5.5% 2022 economic growth target. Growth there will actually be the slowest in 40 years. Let me sum all this up. The economic indicators continue to be moving lower, with the all-important housing sector leading the way. And both retailing and manufacturing are either showing outright contraction or are weakening substantially. Into this environment, the Federal Reserve is intent on moving interest rate policy into restrictive territory and keeping it there until they achieve their 2% inflation target. Because they are looking at backward-looking indexes, the CPI and the Personal Consumption Expenditure Price Index, hitting that 2% inflation target may not occur until sometime late in 2023. In addition, no one, not even Powell himself, is discussing the impacts of quantitative tightening, which will begin in earnest in September with the sell down of $95 billion per month of treasuries and mortgage-backed securities from their portfolio, and that will continue for many months thereafter. That's going to put even more upward pressure on interest rates and downward pressure on the economy, and could pose liquidity issues for the financial markets. So it isn't any wonder that the equity markets reacted badly on Friday and then again on Monday and Tuesday. Finally, from a historical perspective, if we look at post-World War II economic history, we find that there are three conditions necessary for the equity market to find a bottom. The first is that the yield curve must be positively sloped, not inverted as it is today. The second is that the Fed is easing, not tightening. And third is that the economic data are getting better, not worse. We have none of those conditions today.